Welcome to the Deep Dive. We take the sources you've given us, sift through them, and pull out the really powerful, practical stuff. Today, it's all about Charlie Munger, drawing heavily from Poor Charlie's Almanac. He was Warren Buffett's partner for, well, decades. And our mission here is simple. Extract those key insights that go way beyond just investing, things you can actually use in life.
Right.
Think of it as a shortcut to getting smarter, maybe with a few surprises thrown in.
Yeah. And what's really unique about Munger, I think, is his whole approach to wisdom. It's not about finding the answer.
Right.
It's about building this mental framework, using mental models from all sorts of different fields, a multidisciplinary view. That's what we're unpacking today.
Okay.
And these ideas, they come from years of experience. They genuinely help you avoid common mistakes and, frankly, make much better decisions, not just about money.
So, okay, building a mind like Munger's. Where do you even start? It seems like a huge task.
Well, one of his favorites is actually kind of backwards. He says, start with the don'ts.
Start with the don'ts.
Okay.
That sounds simple.
It does. Maybe too simple. But think about amateur tennis. Munger uses this analogy. The winner usually isn't the one hitting amazing shots.
Ah, right. It's the one who makes fewer mistakes.
Exactly. Fewer balls in the net, fewer shots out of bounds. You win by not losing. Playing it safe, in a way.
But doesn't that feel a bit, I don't know, passive? We're always told to go big and be proactive. Is there a danger of missing out if you're too focused on avoiding mistakes?
That's a really good point. It's not about doing nothing. It's about, let's say, intelligent restraint. And this applies so broadly, way beyond tennis or investing.
Well,
Munger's core idea is that consistently not being stupid, and crucially, staying within what he calls your circle of competence, is way more effective than trying to be brilliant all the time.
circle of competence. Got it.
Yeah. So for investing, it means actively deciding which markets or industries to just avoid, stay away from them.
You eliminate things first.
Right. That elimination process actually gives you an edge because you can focus. You understand your risks better. It's knowing where not to go so you don't stumble into trouble.
And you saw that with Munger and Buffett themselves, didn't you? With
Yeah.
tech stocks. They stayed away for so long.
For ages, yeah.
I mean, imagine the pressure to get in on that. Sure, maybe they missed some early gains, but more importantly, they totally sidestepped disasters,
Yeah.
like the dot-com crash. They just sailed right through it.
Yeah.
That's really playing not to lose, isn't it?
Big time.
Yeah.
And you can broaden that out. Munger had that famous quote, something like, all I want to know is where I'm going to die, so I'll never go there.
Okay, morbid, but I get the point.
Right. Use that mindset anywhere. Playing chess, avoid bad moves. Choosing a partner, avoid the deal breakers. Picking a job, rule out the ones you know you'd hate.
So just prune the options.
Exactly. Get rid of the worst alternatives first. It massively improves your odds of ending up with something good. It's a filter. Powerful one.
Okay, this next one really caught my attention from the sources, the Lollapalooza Effect. That's Munger's term, right?
It's his term, yeah.
It sounds fun, but what does it actually mean? It's like 1 + 1 = 3 or something even bigger.
Precisely. It's when several positive factors combine and reinforce each other, making the total result way, way bigger than just adding up the individual parts. Like a snowball effect, but maybe more complex.
A virtuous cycle on steroids, you said earlier.
Yeah, something like that.
What's the classic example he uses?
Coca-Cola. Always Coca-Cola.
Okay.
What's fascinating is how multiple things came together. You had, obviously, a great product people like the taste of, plus the kick from sugar and caffeine that was a big deal early on.
First mover advantage there.
Definitely. Then layer on truly clever marketing. Munger had that quote about, the brain of man yearns for the type of beverage held by the pretty women he can't have.
Oh.
Memorable.
Very. Plus, just making it available everywhere. Ease of access. And then the social proof, everyone else is drinking it, so it must be good. All those things working together.
Exactly. Not just adding up, but multiplying. Creating that huge, dominant outcome. That's the Lollapalooza.
And the result is, well, Coca-Cola. Total market dominance. Most widely distributed physical product on Earth. Yeah, that sounds like a Lollapalooza.
It really is the textbook case. But, spotting these things before they happen, that's the hard part.
Right. If it were easy.
Everyone would do it. So how do you even start to identify potential Lollapaloozas? It really takes that multidisciplinary approach we mentioned.
Back to the different fields.
Yeah, you need more than just finance or business knowledge. You need some understanding of psychology, statistics, maybe even some business law basics.
It's the blend.
That's the blend. That's the secret sauce, if you will. Seeing how different forces might converge, that's how you spot those potential skyrocket opportunities.
So building this mental toolkit Munger talks about. One fast way not to do it, according to him, is just learning from your own screw-ups, right?
Oh, yeah. He calls that the recipe for misery.
Recipe for misery.
Learning everything only from your own mistakes. I mean, just think how inefficient that is, how painful.
Totally. Why step on every landmine yourself when someone else already mapped them out? It's tempting, though, isn't it, to think, I'm different.
Very tempting. But look around. The consequences are obvious. Drunk driving fatalities totally avoidable if people just learn the lesson others already paid for.
Yep.
Or in business, companies going bankrupt from too much debt. It's happened countless times. Ignoring those lessons basically guarantees you'll struggle. You'll achieve less. Why reinvent a wheel that's known to fail?
So the Munger way is the opposite.
Yeah.
You learn from others. You accelerate by standing on their shoulders.
Exactly. Especially the masters in whatever field you're interested in.
It might feel less exciting sometimes, maybe, like diversifying your stocks instead of going all in on some hot tip.
It might feel less exciting day to day, yeah.
But the results are likely way more solid over time just by applying proven principles. It's like, why build your own rickety bridge when there's a perfectly good, tested one right there?
Precisely. And Munger and Buffett are open about this. They talk about building on the work of Ben Graham and Philip Fisher.
Giants in the field.
Absolute giants. And look where it took Berkshire Hathaway, 6th most valuable company globally. It reminds you of Isaac Newton, right? If I have seen further, it is by standing on the shoulders of giants.
Classic.
So the advice is read history, study the successes, but also, just as importantly, study the failures. See what trips people up consistently. Learn from both.
Okay, so investing, figuring out a company's future, it's basically problem solving.
Fundamentally, yeah.
And it's complex, like understanding an organism. You've got internal stuff, products, people, culture.
Incentives, leadership.
And external stuff, laws, competitors, the whole economy. So many moving parts.
Which leads right into another Munger idea. The man with a hammer syndrome.
Ah, yes. If all you have is a hammer.
Everything looks like a nail. You try to hammer everything. It's a terrible approach for an investor.
Why is it so bad?
Because you miss all the nuance. You apply the wrong solutions. If your only tool is finance, you'll try to fix every business problem financially, even if the real issue is, say, bad company culture or a weak product. You just can't see it.
So you need a bigger toolbox, a mental toolbox, not just finance.
Absolutely. But for someone listening thinking, okay, history, psychology, math, biology, law, that's a lot. How do you actually do that without, spending your entire life in university? Does Munger expect deep expertise in all of them?
That's the practical question, isn't it? It sounds overwhelming.
Totally. But no, Munger isn't saying become a world expert in everything. It's about getting a basic working understanding of the big, important ideas from each key discipline.
The core concepts.
The core concepts, the fundamental mental models. His point is, if you lack even that basic understanding, you're operating with huge blind spots, these unknown unknowns he talks about. They cripple your ability to make good decisions.
Like if you don't get basic psychology, how can you judge management or predict customer behavior?
Exactly. Or basic statistics. How do you evaluate data without getting fooled? It's about building this lattice work of knowledge. Not memorizing facts, but understanding principles.
And his simple solution for getting there, it's almost anticlimactic.
Almost, yeah. He just says read. Read constantly.
In my whole life, I have known no wise people who didn't read all the time. Something like that.
That's the gist of it. Read, read, read.
It underlines the whole point, right? Complex systems have multiple causes.
So understanding them requires multiple mental models applied fluently. That's how you become that mental Swiss Army knife, ready for different problems.
Okay, let's pivot to something really practical Munger used. His investing checklist. He talks about how even the best pilots use checklists, right? No matter how skilled they are.
Exactly. It's about avoiding simple, stupid errors that even smart people can make under pressure. Investing is no different. So yeah, let's walk through his checklist.
Okay, first up, risk.
Right.
Yeah.
Always start by measuring risk. You need that margin of safety buying below intrinsic value. Demand more return for more risk. And above all, job number 1 is avoid big mistakes. Avoid permanent capital loss. Don't lose the money.
But measuring risk. The future's uncertain, markets go wild. How do you actually measure it? What's the biggest mistake people make there?
I think the biggest mistake is confusing volatility with real risk. Munger wasn't worried about stock prices bouncing around day to day.
Yep.
He worried about the underlying business failing, about permanently losing your investment. So you measure it by digging deep to the business itself, its durability, its competition, its debt, its management quality. Understand the business, not just the ticker symbol.
Got it. Next on the list, independence.
Crucial. You absolutely have to think for yourself. Ignore the noise, the Wall Street hogwash, as you'd call it. Whether people agree or disagree with you, it doesn't make your analysis right or wrong. Your reasoning has to stand on its own. If you just follow the crowd.
You get crowd results.
Exactly. Average results, at best. But how do you do that? How do you tune out the herd when it's shouting so loudly?
Yeah, especially today with information coming at you constantly.
That's incredibly hard. Munger's answer, again, comes back to wide reading, especially history. Focus on timeless principles. Cultivate detachment from the daily market frenzy. Look at the facts, the long-term value, not the emotions. Your homework has to be solid.
Okay. Then, intellectual humility.
Maybe the most important one. Know what you don't know. That's the starting point. Stay inside that circle of competence we talked about.
Right.
And actively, this is key, actively look for and consider evidence that contradicts your own beliefs. Challenge yourself. The biggest danger. Never fool yourself, he said, because you are the easiest person to fool.
So true. But how do you practice that? We're all so good at fooling ourselves, especially when we love an idea. Any practical tips?
It's tough because our brains fight it. One way is to deliberately seek out smart people who hold the opposite view and just listen. Try to understand their argument fully before you even think about refuting it.
Steel manning their argument.
Kind of, yeah. Munger also used inversion. Instead of, how can this succeed? Ask, what could make this fail? That forces you to see the downsides. And maybe write down your reasoning before you invest so you can check it later against reality.
Good discipline. Okay, next. Allocation.
The investor's main job, really. How do you deploy your capital? Always think about opportunity cost. What else could you be doing with this money? Right. And Munger believed good ideas are genuinely rare. So when you find one where the odds are heavily in your favor, bet heavily.
Go big.
Go big, but crucial. But don't fall in love with it. Stay skeptical. Keep checking your thesis.
Betting heavily sounds exciting, but how do you really know the odds are stacked in your favor? How do you avoid just convincing yourself they are?
That loops back to the hard work, the multidisciplinary approach, the humility. You know the odds are good because you've done the deep dive, applied different models, maybe even spotted a Lollapalooza dynamic. It's not just a gut feel.
It's reasoned conviction.
Exactly. And to fight that confirmation bias, force yourself to argue the other side. If you can't make a decent case against your own investment, you probably haven't thought it through enough.
Makes sense. And there's patience.
Patience. So hard, so necessary. You have to fight that constant urge to do something. Remember compounding the eighth wonder of the world, right? Don't interrupt it unless you absolutely have to.
Let it work its magic.
Let it work. And try to enjoy the process, not just fixate on the outcome. Guard against getting cocky when things go well or bored when they don't seem to be moving.
Patience feels almost lazy in today's world, doesn't it? How do you square that with needing to be decisive when opportunities arise?
Right.
What stops people from being patient?
I think the biggest obstacle is just our wiring. We want action, results now. Patience isn't lazy, though. It's disciplined inaction. It's having the strength to wait when waiting is the smartest move. Understanding that real wealth builds over time. You square it with decisiveness, because decisiveness is for those rare moments of opportunity. Patience is the default setting. Wait for the fat pitch, as Buffett says.
And finally, decisiveness.
The flip side of patience. When the right moment does come, you have to act boldly with conviction. That famous line, be fearful when others are greedy and greedy when others are fearful.
Contrarian thinking.
Very. Opportunity's rare. Grab it. But, and this is the kicker, you have to stay prepared. You can only recognize and seize opportunities if you've done the homework beforehand.
So how do you avoid getting stuck in analysis paralysis and actually make the move, especially after focusing so much on being careful and patient?
It sounds like a paradox, yeah. But the decisiveness actually comes from all that preparation, the reading, the learning across disciplines, the checklist, thinking that's what builds the conviction.
I see.
You've already thought through the risks because of your humility. You're not swayed by the crowd because of your independence. So when the truly great opportunity shows up, the decision isn't impulsive, it's the logical conclusion of all that prior work. You're ready.
So here's a final thought for you to maybe chew on after this. Consider how deliberately focusing on what you want to avoid the mistakes, the bad situations, the guaranteed paths to misery might actually, paradoxically, make you better at spotting the truly good opportunities, maybe even more so than just chasing after whatever you think you want right now.